All right, so this is going to be a walkthrough of the different valuation models and more specifically the inputs, not necessarily explaining all the aspects of how the valuation models work. All right, so you probably got a link that looks something like this. You want to make sure to not double click to open it because it's going to open it in Google. What you want to do instead is over here, click download and then open that up from your file explorer. That'll open up in Excel. All right, so looking at first the completed one, let's give it a second, pop up here. Um, this is going to be the example, and so I utilized Apple. Not all of the like inputs are entirely accurate, but for the purposes intended, they're fine. So the main thing here is going to be inputting each of these numbers from the financial statement. So if I were to pull up Apple and literally look it up on Refinitiv, it would look like this. Then navigate over to financials and then go over to the income statement to correspond to this right here to facilitate my ability to find these line items. Then I can go one by one and making sure that my scaling is in millions and my standard currency is US dollar or standardized if it's already a US company. And then I want to have at least like the last 7 years. Mine is auto on last 10 years. If you make any changes on here, make sure to click update view. All right. So if I'm looking to get the revenue figures for each of these years, I'm going to go line item by line item, scrolling through, and basically go about copying these down. You can't copy and paste. What you could do is open the income statement in Excel if you wanted to do that. Make sure that whenever you do open it in Excel, you're looking at the right years because sometimes when Definitive it prints it out in reverse. So let's start with 2024, then 2023, then 2022, and so on. So if you are going to open an Excel file of the income statement, make sure that you're keeping an eye on that. And if you want to know how to do that, I did that in a previous video, going over graphing and all those kinds of things. All right, so this would go line item by line item. So for revenue, this would be revenue from goods and services. And I would basically transfer over and write down each of these numbers in the corresponding year. Looking at cost of goods sold, that's cost of operating revenue. And I would go ahead and transfer that and write that out here. And an important thing to note is that part of this portion of the valuation involves using rationalization and distinction. So this is part of the skill set of understanding what these line items are. So for example, if I were to try to get SG&A expense and write this down as a line item, I might want to just automatically go to SG&A total and then write this down year over year. But recognize that I also asked for R&D expense and we have that separate. And R&D expense is actually underneath this SG&A expense total. So I need to make sure that I'm not counting that twice. So if I were to count this and then also write down R&D expense, I'd be counting that expense twice. So what I need to do instead is take down this as SG&A. If this had a value in it, I would add these two together and put that in SG&A. And then R&D, I'll use just this R&D figure. So it's important to kind of keep an eye on things like that as well. Looking over at the balance sheet, I'm going to do the same thing. Looking for example, cash and cash equivalents, take that total sum of cash equivalents, short-term investments, that's marketable securities, short-term investments. So I take this line item, for example, for cash equivalents. AR, you're looking at all of these receivables, so loans and receivables, but you see that inventories is also in AR. So for example, I asked for inventories right here, so you're going to make sure that that's actually separate. So you're going to count this as a line item for inventories, and then you're going to actually instead take um, the trade accounts and trade notes receivable net as opposed to this one right here. Because if you see if I collapse this, it also takes into account inventory. So make sure that you actually separate those two. So take inventories total and then take receivables total and don't let yourself kind of get confused and count one with the other. All right. So if you were to go about doing that for the rest of it, that would take you down to the debt schedule portion. So you could go through each of these financial statements, pull each of these models, pull each of these figures for each corresponding year. So debt schedule is somewhat different. So I have notes on each section of this, but for the debt schedule, we're looking at beginning period debt. So looking at the balance sheet, we can navigate over towards non-current liabilities, debt, long-term total. And since we're looking for the beginning period debt, you're actually going to utilize the previous year's long-term debt. So if I was doing 2020, I would input 2019's long-term debt, for example. Then we're going to look at additional debt and debt pay down. These aren't going to be in the balance sheet. They're going to be in the cash flows from financing. So make sure to look for that. All right. Then dividends, it's going to be for common stock. These portions right here. So as you can see, each of these inputs is outlined in black, while these do not have that outline. So that is because these are optional, while these are necessary for the model to fully function. So why are these optional? Well, let's say that your company has mentioned in its earnings calls or in its management discussion part of 10K that it's planning on issuing more debt in 2026 or issuing more debt in 2028. Any of those kinds of things, you're going to want to write that down here. Or they're planning on paying off X amount of debt in 2025 or paying off X amount of debt in 2028 as well. So looking at those earnings calls or that management discussion part of the 10K is really important when it comes to that. If you don't have anything here, if your company isn't doing any of that or hasn't announced any of that, just leave it blank. Don't input zeros, just leave it blank. All right. And that same thing goes for any of these. So you can see prepaid expenses. I didn't like, you don't necessarily need to input zero. You can just also just leave it blank. All right. So going over to this portion. All right. So some of you have buybacks as one of your drivers. So this is going to be pretty important to account for. So if your company is planning on buying back stock or repurchasing stock, you're going to want to use this section. You want to use this section right here. And if your company is planning on issuing more stock, you also want to note that right here. So that would also be in earnings calls, management discussion, those kinds of things. And if your company is doing buybacks, there's probably some sort of repurchase schedule where it says how much they plan on repurchasing when. And you'd go ahead and denote that right here, also in millions. All right, so while these sections in the forecasting are optional, this right here is not, and this is the revenue year over year growth. So these are actually the growth rates that we're going to use to drive revenue, and that drives a lot of your third statement model. So what we're going to do to get these, typically what you can do is you can look at either management projections or analyst reports, or you can form your own perspective if you have the data essentially to back it up. But the idea here is to go about finding this in some method and input it for each year. So growth 2025, growth of revenues in 2026, year over year growth is what we're looking for here. Another important thing to note is you might have something like, oh, we're going to grow revenues by X% by X year. You could go about inputting a bridge in that case to calculate what each year's growth looks like to eventually get to X growth, if that makes sense. And if you want to learn how to do that, you can try to, well, you can talk to me. And we can try for that. But it's better, of course, if you're able to get something a little bit more concrete for each of these years based on analyst reports or any of those kinds of things. All right, so that takes us through all of these inputs. The last input on this sheet is going to be the effective tax rate. So you're essentially just going to look this up, look up Apple effective tax rate and go ahead and denote that there. I think you can also find it on Refinitiv, but I'm not taking the time to do that at this moment. All right. So the other inputs you're going to be doing are going to be over here, primarily looking first at the cost of equity. So we're going to navigate away from financials. We're going to go over to overview and click valuation right here. All right. So Once we're here, we're able to quickly get all of this information. So market cap is actually right here. As you can see, it's in trillions. So you want to make sure that that's also in millions. So denoting that right here. The risk-free rate is going to be the same for everyone, but you can also go ahead and look that up. Your beta is going to be right here in theory. I guess mine isn't loading. Typically, you'll have like your um, 5-month beta, but that's all right. Um, and then you will also get your market risk premium. You can go ahead and look that up as well. That's going to be about the same for everyone, unless you have some sort of crazy thesis. All right, so shares outstanding, that's going to be right here. Make sure to also convert that to millions. And then current price is the current share price of the company. And then looking at the market value of debt. So what we're going to do for that is also on this overview valuation, you're going to scroll to the bottom and you're going to see this debt section. If I was full screen, it would look like this, where it says total debt, and take that number and make sure it's also in millions. All right, that gives us market value of debt for our purposes, somewhat simplified. And now we're going to go about calculating cost of debt also in millions. So there's a lot of ways of calculating cost of debt. The way we're going to use it, the way we're going to do it is by getting a weighted average yield to maturity. And we're going to take the 6 largest portions of debt that we can find available and go ahead and weigh those out. So that's what these inputs are going to give us. So how do we go about actually getting these inputs? Well, we can navigate over again to the company page. All right. Yeah, now we can see the 5-year monthly data that I was mentioning earlier. And we're going to navigate to this section right here that says debt and credit. Clicking on debt structure will take us to a screen that looks like this. Yours might look like this, where it automatically has a bar chart instead. And what you're going to want to do is click on pie chart, and this will show you the distribution of your debt by maturity date. So like, or by maturity year, I guess, better put. So when will the company have to pay this back by? You can see this largest tranche over here is a bunch of different years after 2042. So if we click this, since we want to emphasize the largest portions of our debt and make sure we're weighing those, we're going to click this and we're going to look for the largest outstanding value out of these. So 6 billion seems to stand out. So we'll go ahead and click this, and that will open up another section down here where it will show us 2 different bonds issued for a total amount outstanding of 6 billion. So what you're going to want to do is utilizing this 6 billion number up here, we're going to take these two as one. You're going to take that total amount outstanding and input it as face value. So it doesn't matter in which of these slots. You can do it in debt instrument 1, debt instrument 2. It'll all get weighted the same. The order doesn't matter. But you're going to want to go ahead and input it. So I did it right here. And make sure that you're inputting that in millions as well. All right, so once you've done that, we're going to get the price. So trying to get the market value of what this debt looks like. So if we click on it down here, it'll open up this window and it will give us issue date, price, and yield. So the price right here is 99.42. And what that tells us is that this bond is trading at 99.42 cents on the dollar. So that's trading currently at a discount. So we're going to denote that by writing it down right here, 99.4. And that's going to be what we do there. But note that we're taking 2 and counting them as kind of one value here. So we're going to look at this one as well and try to see what its price is at. It's trading at 99.7 cents on the dollar. So what you could do is go ahead and average those two. You could essentially do equals average and then do like whatever sort of numbers they gave you. Let's say it was like 10 and 5. That's obviously the case. And then it would go about averaging those two out. But for simplicity, I just did like a number that was ballpark for the purpose of example. So depending on how specific you want to get, you might just input a number that's between those two numbers. You might want to do an actual average, up to you. All right, so that's one example. But now, as we're looking at Right. We also need to do the yield. So, um, as you can see, whenever we click this, make sure this one didn't have it. Whenever we click this, it showed you issue date, price, and yield. So it shows you yield here, but we're actually not going to use that yield. We're going to use this one right here. And as you can see, these two are also different. So you get the average of the two, or you could just input something that's in between them. I just went with 5.2 for the purpose of simplicity and example. And that completes our one of our debt instrument inputs. But now where do we go from there? Well, we're still in this anything after 2042 section, and we can see that a lot of these are a lot smaller than 6 billion. So we have like 1 billion, 1.5, 3 billion. But if you go over here, these are also individual years. And this one is 7 billion, 7.9 billion, which is significantly larger than 1 billion, et cetera, et cetera. So I'm going to go ahead and click this one, and it'll open up all of my 2025 bonds. So I'm going to take this total amount outstanding because basically this total amount issued can differ from total amount outstanding in case they paid down any amount of that debt. So you want total amount outstanding to get whatever is still not paid down now. And you're going to take that and input it as face value. So we're going to take all of these basically as one input. And now we're going to get price in the same way. So I'm going to click on one of them. We're going to say, okay, we have 99.3 here. Let's see, we have 99, what is it, 99.4 here. They're all going to be relatively similar unless you have a very distressed company or an emerging company, any of those kinds of things. So you can go ahead and click on all of these and average them all out, or you can maybe just pick something that's ballpark, depending on how you're feeling, I guess. So I basically went with 99.5. And then your yield to maturity over here, the yield about the same. They're all different. You can take an average. I went with 4.3 since they're all essentially 4.3, and I input that there. So you can go ahead and do that for additional um, sections, additional debt instruments, until you have all of your key inputs. And that's it. That's all you have in terms of inputs for these two things. What you're going to do is you're going to eventually take this section, which is the DCF, which is calculated from those inputs, and you'll paste this into your PowerPoint along with um, the metrics up here. You might also want to add like cost of equity and then link that to cost of equity so you can have a bit more of the key metrics here, and then maybe reorganize these so that your implied upside and your current price are still at the bottom. That's up to you. Um, but as you can see, we don't have a strong upside, and that's primarily because, a lot of these inputs are semi-bogus, and also Apple has negative earnings. But that will give you your DCF. And if you have any sort of difficulties, please let me know. Otherwise, best of luck, you guys. Really, all you have to do is these inputs, then these inputs, and you should be set. All right. That concludes the end of this video. Best of luck.